The third plenum in China is expected to unveil reforms that will improve China's business environment and make it easier for foreign investors. I spoke to Sheldon L, Senior Portfolio Director at Morgan Stanley, and I asked him about his investment strategies specifically in China.
I'm very interested in the Hong Kong market. It's one of the best in the world, as you well know. At any given time, we've probably got between 8 to 12% exposure in Hong Kong equities. Additionally, anything we own just about in the world is related to China's economic health, whether it's Rio Tinto, BHP, or Caterpillar. Everything's linked to China.
So a lot of it is about the growth in China. Now, there's this weekend, there's a fairly big meeting coming up where they'll discuss social and economic potential reforms. The expectations are very high for reforms. How does a meeting like this impact the way you look at your portfolio?
It'd be very dramatic. I mean, it's very difficult to assess until we know more. But so much of these things are interlinked. People are calling for state-owned enterprise reform. That's going to impact companies like PetroChina, China Mobile, et cetera, and how they perform. There's possibly more risk there. But also people are calling for those companies to pay dividends to the government that can then improve the social safety net and create more spending for consumers, ideally.
Part of what you do is look at balance sheets and cash flow statements and income statements, so you want to see companies make money. But on the other hand, you're also looking at sort of the macro economy, what China is doing on a big picture level. What's more important to you, the profits or the overall macroeconomic picture for China in terms of GDP growth?
I guess I would begin with dividends. As Warren Buffett, I think, once said, you can lie about your earnings, but not your dividends. If a company has dividend strength, it's an indication of business strength. And of course, the macro plays into that. I mean, if the macro picture's getting to be a bit dicey, then the ability to pay out dividends would be dicey.
There's a couple ways to invest in China. You can invest in Chinese companies who have large operations domestically within China. I mean, obviously, that's the pure sort of investment. But there's also a lot of companies from around the world, in America or Europe, that have significant operations in China as well. How do you decide which one to go with?
I mean, although these companies do benefit from their business in China, whether it's Coca-Cola or HSBC, et cetera, I think a more pure play is to use the H shares in Hong Kong and Hong Kong companies as well. They're going to get the benefit. And those markets look very cheap right now. I think the forward price earnings ratio in the Hang Seng is below 11 versus about 16 on the S&P 500.
But look, I mean, to be fair, emerging markets have always traded at a discount to normal markets, okay, developed markets. But that's changed recently through the sort of the BRIC infusion, where we got this substantial growth and people start giving a premium. Part of the reason why Hong Kong, or even China, the H shares for that matter, have a bit of a discount is this overriding concern about a potential slowdown, this concern about would the housing bubble perhaps be an issue. All these things come into play. Do you worry about that?
I do. I think the discount's overdone, though. I mean, Hang Seng having a PE of around 14 or 15 is quite normal, and it gets excessive at 18 to 20. That does happen. So at this level, I think it's overdone. As far as the housing bubble, there's clearly risk in mainland China with overdevelopment and some of the developers becoming stretched financially. But unlike the U.S., there's no real possibility of housing collapse and defaults because of the lack of leverage.
One thing that you probably know about this, if you've been focused so much on Hong Kong, is that Shanghai, the government obviously is pushing Shanghai to be a major financial hub. The liberalization of not just foreign currency, but also derivatives and also equities, all these instruments that financial experts use, they're focusing a lot on having Shanghai be a big part of that. The problem is that that's also what Hong Kong does as well. Can China have two financial hubs, essentially?
Absolutely. They've always complemented one another over time. And Hong Kong is not a complacent place. These people are always ahead of the curve, and I think they'll remain so. So rule of law, convertibility of currency, these other things Shanghai lacks will come, but if Hong Kong does nothing, Shanghai will take over. But that's highly unlikely.